A very warm welcome to all of you to today's webinar on digital money and finance, what's new. This webinar is co-organized by CEPR's Research and Policy Network on FinTech and Digital Currencies, as well as SWEF, the European Money and Finance Forum, and Cbdc, the virtual seminar series. My name is Dirk Niepelt from the University of Bern, and it's a great privilege to introduce today to you three excellent speakers on that topic of digital finance. We have, on the one hand, Daryl Duffy from Stanford University, Todd Keister from Rutgers, and Harold Uhlig from the University of Chicago. And the three of them combine, as you know, a very deep understanding of macro, money, and finance, both from a theory side, but of course also from a policy and more applied side. The three of them have agreed to start this whole thing up by giving a short introduction, their perspective on the issue, like 10 minutes at most. And after that, we'll be opening up for Q&A. You can pose your questions if you should have any on the Q&A function on Zoom. I will follow these questions and then try to select and pose them to the speakers. The speakers have also agreed actually to make their slides available. So if you're interested in those, you'll be able to find them later on CEPR's RPN website. We'll start with Todd as the first speaker. So Todd, the floor is yours. Thank you very much.
Okay, well, thanks very much, Dirk, for organizing this and for including me. Is the screen sharing okay? Yeah, all right. So what I wanted to do in my opening remarks today is Dirk set a question for this session, which is, do we need to rethink money, banking, and finance in light of the digital transformation that's ongoing, or do conventional theories apply? And the answer I want to give is yes, both. And let me explain what I mean by that. So I think it's clear to all of us that digital innovation is raising a lot of new and super interesting issues and questions, right? I gave some examples here. You can all think of many more. And, you know, one way to think about the question is to interpret it very narrowly in the sense of, do we already know the answers to these questions? That is it just a matter of finding the right book or the right article, looking up the right existing model, applying it, and answering these questions? And I think, you know, if you interpret the question narrowly like that, I think the answer is, well, clearly we don't know the answer. There's a lot of work that's needed. There's a lot of work that's going on to address these issues. But I think it's also useful to step back and take a broader interpretation of the question. That is, do we need a complete rethink? That is, do we need to go back to square one and design a new digital economics and digital finance to apply to this new digital economy? And here, this is kind of the main point I want to focus on is I'm going to argue the answer is no, right? And why is that? Well, a lot of people have made this point. Digital money and digital finance is largely about finding new ways of solving long-standing fundamental economic problems, such as how to transfer ownership of assets like money, how to provide liquidity while financing investment, and so on. And existing theories, you know, we have a large body of economic knowledge that addresses exactly these fundamental problems. It's been developed over decades. And I want to argue that knowledge provides us a solid foundation for answering these new questions. And to illustrate what I mean, let me just go quickly through three examples. So let's start with Bitcoin, right? So in some ways, Bitcoin is quite revolutionary, right? It's this asset that's very clearly not backed by anything or anyone, and ownership can be transferred in this kind of ingenious decentralized way. So one of the first questions that comes up is, well, what would determine the value of such an asset? If we think about, you know, an asset that's not backed by anything or anyone, there's a lot of work in monetary economics on exactly that question. Right, so you know, you could think of going back to Diamond 1965 as a starting point for providing an answer to that question. Diamond interpreted the asset in his model differently. He talked about government debt. Later, people talked about that same asset in the same model as money. Some people like Turol talked about it as a bubble. And you know, when you're thinking along those lines, maybe that's a starting point to think about Bitcoin. And so if we think about the foundation, the literature built on Diamond, you know, what are the key results that came out? The key results that came out is an asset like this can have value in equilibrium. The economic fundamentals will pin down that value in a steady state, but the value is fragile. It can collapse and it can exhibit a lot of non-fundamental volatility, sunspot-driven volatility. And if we think about the exchange rates between different assets like that, they tend to be indeterminate. The economic fundamentals do not pin those down, and they also can be highly volatile. And these are results that came out of this overlapping generations framework. But if you revisit the same issue in a more modern monetary framework, you'd get similar results. So what's the new literature doing? You know, what I want to argue is the new literature is building on those foundations. And here I've listed a few papers. There are a lot more, but you know, Garrett and Wallace did an OLG model. Schilling and Uhlig have a model where it's more of a transactions-based model, looking at exchange rates between different types of assets. Here are some others. You know, I'm sorry, I don't have more time to talk about these in more detail, but what I want to emphasize is this is not a matter of pulling the old models off the shelf. Right? There are important new elements in these models. In particular with Bitcoin, the supply rule is different. Bitcoin is produced by miners who face particular costs and particular incentives. But at a fundamental level, Bitcoin has some familiar features when we think back to this older literature. And the point I want to make with this example is that the literature that studied those features in general settings has provided insights that are also applied to this environment. You know, if you think about the basic insights from that literature, they seem relevant for thinking about Bitcoin and other cryptocurrencies. And also it's provided the foundation for this very interesting modern literature that's directly addressing the specifics of Bitcoin and other crypto assets. So that's one example. Second example I want to talk about is stablecoins. So stablecoins are aiming to provide a widely accepted blockchain native form of money. And in the process, they're doing maturity transformation, much the same way that banks, money market mutual funds, and a bunch of other institutions do maturity transformation. So basic questions here are things like, well, how stable should we expect the value of these coins to be? And how can they be designed to maximize their usefulness while avoiding bad outcomes like self-fulfilling runs or collapses? And the foundation I want to point out here is this paper by Ed Green and Ping Lin in JET in 2003. And what they did was they studied a version of the classic Diamond-Dybvig model of maturity transformation. But they were very explicit about the information, the feasibility constraints, and the incentive constraints in their environment. And the result, you know, in rough terms, the result was that a bank that follows the efficient allocation rule does insulate itself from self-fulfilling runs. But the rule is complicated. And in fact, the value of deposits has to adjust dynamically in response to the withdrawal behavior of depositors. And the paper was criticized by some people as being unrealistic. That's not what a bank looks like. The value of $1 in the bank is fixed. It's not adjusting dynamically. Okay, but if we think about stable coins, right, the value of a stable coin does change with market conditions. And so there's a sense in which this Greenland framework maybe is actually closer to a crypto coin than it was to a traditional bank. So I just wanted to mention a couple papers here that build on that foundation. One by Brian Rutledge and Ariel Zaitlin-Jones that just came out in this special issue of the JDC on the economics of digital currencies. And what they do is they modify the Green and Lin approach to study stablecoin design. And interestingly, they actually implement their coin using smart contracts on Ethereum. And you know what they show is that the fundamental trade-off's kind of the same. But for a coin to be stable in the global sense, meaning no self-fulfilling runs on it, the value needs to vary with demand. It can't be perfectly stable in a local sense. Also, an interesting paper by Shuisong Huang, who's at Sun Yat-sen University. His starting point is, you know, one thing that's different about stablecoins is because they're on-chain, the transaction history is public. So I can look and see what other coin holders are doing. Are they redeeming or are they maybe increasing their balances? How does that information affect the stability of the coin? So what Shuisong does is he said, let's take this Greenland framework as a starting point. Let's change the information structure to make it closer to what a stablecoin really is. And what he shows is interesting, that this public information feature can actually help stabilize the coin and prevent runs. Okay, so again, the main point is that these existing models of fundamental economic issues and trade-offs, like Green and Lin and others on maturity transformation, are providing a good foundation for understanding the new digital incarnations of these issues and the new features that they're bringing. Last point, quickly, central bank digital currencies, right? A lot of discussion. I imagine we're going to talk about this more today. One of the issues that comes up is, will this public money, CBDC, crowd out privately created money, bank deposits, with implications for funding costs, investment, and so on. And this echoes sort of this classic question in monetary economics: what's the optimal mix of inside and outside money? And this is kind of, like a personal story now. So Daniel Sanchez and I were working on this inside and outside money issue. We had this Philly Fed working paper about managing aggregate liquidity, not thinking at all about digital currencies. We're building on the literature there. But then we were hearing people talking about central bank digital currencies. And it took sort of an embarrassingly long while, but we eventually realized, oh, these two things are linked. This big issue was actually related to something we're working on. And so the result is we sort of dropped this, rewrote the model, and ended up with this paper that's forthcoming in the RE Stud. Okay, so there's some advertising there, but hopefully the advertising's okay because it's sort of reinforcing this main point. The digital transformation is raising these new questions, right? And some of these questions, they're interesting and some of them are really important, but we don't need to start from scratch. We don't need a complete rethink. Digital money and finance are attempts to provide new solutions to longstanding problems. Because of that, we're seeing familiar issues and familiar trade-offs coming up just in new settings. And so to address those questions, we can build on this body of fundamental research that's been done over the years. Okay, and with that, I will stop.
Thanks very much, Todd. So the fundamental issues remain, but the aspects that receive most emphasis maybe have changed slightly in this new world of digital finance. Harold, the floor is yours.
So thanks. So here's my slides. I hope they can be seen all right. So there's a lot more on the slides than I can possibly present, but they're going to be made available. So Dirk asked us this set of questions and makes us look into the crystal ball here. So let me have a go at it. So this is how I view the landscape. We now have privately issued cryptocurrencies, starting with this Nakamoto paper from 2008. It's an exciting new technology, the blockchain, which offers lots of new technological possibilities like smart contracts and decentralized finance and so forth, which I think are exciting and are said to revolutionize the way we do financial intermediation. Today, there are 10,000 plus active cryptocurrencies, 300 million users. Entry by big players will happen. I mean, okay, Facebook Libra failed, but that won't be the last. That all competes with traditional means of payments, cash deposit accounts, credit cards, the layered system on top of that, things like Apple Pay, you have PayPal, you have fast retail payment systems. So finally, if the central banks also wanting to get into the picture, both on the wholesale and the retail side. And the question is, why? So the Federal Reserve Governor Chris Waller called this a solution in search of a problem. And it's something that we need to, think through very seriously. I view them largely as a response to the competition of private cryptocurrencies, or maybe sort of go with the times, make things digital. But there are lots of other arguments why or why not you might want to include them, and I want to touch on them to some degree. Finally, I think an issue that hangs over this all is this whole trade-off between privacy and criminal activity. There's a whole bunch of people that can't wait for cryptocurrencies to be outlawed because they say they're only used by criminals to make illegal transactions. And, that's true to a good degree. But they're also used by people that just want their transaction to be private and not being watched or possibly thwarted by governments. And I don't think there's a clean resolution here. There's this quote in this Anon movie where the main actress at the end said, "It's not that I have something to hide, I've got nothing I want you to see." So I think we need to respect this desire for privacy. All right. Now, the first point, now I want to get into a couple of detailed points. The first one is, the recent collapse of the cryptocurrency market, has made headlines in the newspapers and people said it's dead. I would argue it's alive and well, because once you look at this prices in logs, which transfers absolute changes and percentage changes, you see that the recent collapse is nothing unusual. And it's sort of, the recent, half year or whatever, doesn't really stand out in this picture. So that's one thing, just throwing cold water on the idea that this is going down anytime soon. All right, so we wanted to understand the pricing, and Todd had already hinted at that. And if you come from an asset pricing perspective, it's a little confusing because the net present value of these cryptocurrencies is zero. And you could ask, can it serve as medium of exchange despite volatility? Okay, I mean, one country has tried, didn't work there, but conceptually, could it, right? And what are the monetary policy implications? So now I'm going to talk about the research, because Dirk asked this question: how can we, should we write down some new models? So I'm going to talk about the models that I wrote down because I know them the best, and that is sort of maybe one way of, you know, going into the specifics of how one might want to think about some of these phenomena. So in this paper that was published in the Journal of Monetary Economics in 2019, we write down a new model. In contrast to an OLG model, these guys live infinitely long. So in principle, they could hodl Bitcoin. You know, that was something that we wanted to see whether would emerge. And what happens then is that you get this pricing equation that we call the fundamental pricing equation that essentially set the Bitcoin price just a martingale. So if you ask me for the best prediction what a Bitcoin is worth 5 years from now, I look at the current Bitcoin price, around $20,000, and that will be my prediction. It's a version of the results in the classic Carrington, Wallace, and Manueli Peck literature that Todd already quoted. We find that we can't find a good reason for hodling, so that's still on the table. You know, the volatility is not restricted. Basically, once you have a martingale, that's all that we get from equilibrium. So that doesn't invalidate the medium of exchange functions once you put 2 and 3 together. And finally, for the monetary policy implications, you know, if you look at a quantity theory equation, that's the easiest way to do it. That's sort of down here. And you look at the total stock of money, which is the dollars plus the Bitcoin times their price, and let's hold volatility constant here, and you want to target some nominal GDP level, let's say the central bank wants to target a certain price level, then as you have more Bitcoins, or as prices in Bitcoins rise, that means the dollars have to be lowered. So there's a sense in which the Federal Reserve pays the miners, and it's something we're thinking through harder. All right, now private digital currencies provide competition to central banks, and I thought through that in 2 more papers, you know, one with Pier Paolo Benigni, Linda and Schilling, you know, that was sort of, you know, motivated by the possible introduction of Libra or Diem. And the other one is with Taoyuan Xi at Singapore University. And the upshot of this is that large privately issued cryptocurrencies will be competition, therefore headaches for central banks. No surprise that they are, you know, not particularly happy about them, let's just say. Finally, you have this whole world of decentralized finance, smart contracts, and stablecoins. Very exciting because you can put these automized contractual arrangements on the blockchain. Now, the key issue there is that you often want to make payments in dollars or equivalent. You don't want to do them in some, you know, randomly fluctuating cryptocurrency. So stable coins are of essence for that environment to flourish. Lots of banks are getting into that world because they see that as a way of, you know, shortening backdoor operations and making, you know, transactions cheaper and faster. And so it's used, right? And so there are all these layers where now traditional financial institutions get into that, and they want these stable coins. I mean, that's really what they're attractive for. And you can make very stablecoins arrangements. I mean, Todd already talked about this as narrow banks, as money market funds, doing maturity transformation even, or doing algorithmic stablecoins. And the algorithmic stablecoins, of course, led to this Terra Luna crash in May this year. It wiped out, I should better say, better redistributed, if you think about it, $50 billion US, or maybe $600 billion US, according to Barron, and led to, you know, collapse of the Celsius network, perhaps, right? I mean, here's a picture of a paper that I just recently wrote on this. You see the market capitalization of Luna, which is underlying the stablecoin Terra USD, you know, going up, and likewise Terra USD. This was all going fine, and then suddenly over the course of 2 weeks, you know, this just crashed down. And understanding why that happens and did it have to happen, you know, that's the point of that paper. So that gets cited now in the Biden proposal for regulation. So there are lots of people calling out for regulation, consumer protection. And there are lots of people also calling, you know, we need these stable coins, so why let's have the central bank issue that as a wholesale CBDC, so that financial institutions can run on a central bank issued blockchain and trade in a central bank issued stablecoin effectively. But you have to be worried, right? Because governments are not very good at technological innovation, and you know, all these markets and all the innovations are running so fast, and by the time maybe the central bank have something that's workable, another decade goes by. So I say, maybe it's better to just have a supportive regulatory framework, not one that tries to throttle innovation, but one that enables innovation, as well as backstops for those that wish to pay for it, right? In case you want to ensure some stablecoin arrangement, okay, then you have to pay some insurance fee, and then maybe the government can protect you. That should be an option, but it should not be a requirement. All right, then finally, let's talk about central bank digital currency. So what's a central bank digital currency? It's an interest-bearing account held by households at the central bank. That's how I want to think about it. Likely to be introduced widely. It's already available in the Bahamas and other places. And has, financial inclusion is down as a good advantage of this, but there's a threat there, right? I mean, these things may become so attractive. If you have an account at the central bank, why do you need a deposit account, right? So there's competition now, and if that may result in banks just losing their funding, there's this disintermediation threat. So one solution is if the banks just get more competitive, if their households reinvest the CBDC at the bank. So I think of Daryl Duffy as having pushed that point in particular, but the number of papers out there in the literature, and I would count Todd there also. Or alternatively, the central bank then takes all these funds and then somehow refunds the banks or the projects. So that's a point made in a very nice paper by Brunermeyer and Dirk. So I want to think about the latter here in the extreme, right? So here's a picture of this, how deposits are gone, and now the central bank effectively funds banks, ultimately funds loans, ultimately against the maturity transformation. And with maturity transformation comes run risks, and so you have to think about trade-offs between efficiency, right, where you want to have the optimal risk-sharing arrangements, monetary trust, where you want to avoid breakdowns of this maturity transformation, and price stability. So we argue that there could be a run on a central bank. Now that sounds a little bit crazy, but once you think that the central bank is involved in maturity transformation, it's not that crazy at all. And a run on a central bank will take the form of a spending run. You run away from currency into available goods, necessitating early liquidation in a diamond diptych type environment. And as a key result, we show the CBDC trilemma that out of these three objectives, you can only achieve two. I think it's something that we need to take very seriously as we head into this new world. Okay, so the currency landscape is changing dramatically. The cryptocurrency market is $1 trillion. We can't ignore that anymore. Big players will introduce foreign countries. It's too easy to do, right? Certainly once they have regulatory framework, we're going to see that. And that means central banks will face competition. You have to think through these privacy concerns. I don't think CBDC is going to fully solve that. So private cryptocurrencies will continue to exist and flourish. And that's a good thing because we're getting all these new technological possibilities that I think are exciting. They can be abused, but I think they're also very useful. And challenges to financial stability and regulation, to research, but don't be afraid, this will improve our lives. So thanks.
Right, New World. Thank you, Harold. And last but not least, Daryl, introductory statement, please.
Thank you so much, Dirk. Well, what a pleasure to be here today and discuss this topic with such an expert group. So I'm going to just show some very simple illustrative slides. The way I think about this is that it's not about the policy issues that we're grappling with now are really about the economics of it and not about the technology. And I'm going to explain what I mean by that. Let's go to the screen. So in the last couple of years, most people are entering this topic from the lens of a central bank digital currency. So here we have Alice and Bob, and the CBDC is seductively simple. Alice simply sends a instruction to her payment service provider, asking the payment service provider to take $8 out of her account at the central bank and put it into Bob's account at the central bank. And Bob gets a message saying, the money is there, you can give Alice her merchandise, and away she goes. Very, very simple, cuts out a lot of spaghetti in our current system. It's often introduced as allowing payment use cases that are not easily allowed with our current bank rail payment system. I actually would disagree with that. The banks are perfectly capable of, it doesn't look this simple, but they're perfectly capable of offering payment services that work about as well. And as Harold hinted, perhaps even better, given that the private sector is better at technology probably than the government sector. So why are we talking about this? Well, I think it's not about technology. I think we're talking about it because there's a lack of competition in the banking sector, banks are not competing against each other very hard for payment services. And they're not innovating because they don't have to. They have a very cushy position. It's oligopolistic and it's under a protective umbrella of banking regulation that seems to deter entry by other payment service providers. So what I want to do in the next few minutes is just to enlarge on that theme. So one of the other alternatives to CBDC for striking up some competition for the banks are private stablecoins. And again, we could debate the technology. If this were to get going, it would put some pressure on the banks. However, the President's Working Group report on stablecoins that came out last year strongly recommends that Congress legislate so that only banks are capable of issuing stablecoins, and that's in order to keep them safe, protect consumers and protect financial stability. And as Governor Chris Waller of the Fed has said, how could this possibly increase competition if you're restricting stablecoins to be only issued by banks? Now, there is one possibility, which is the Fed could give special accounts at the Fed for narrow banks that only do payments, and that those narrow banks could then provide competition for legacy commercial banks. However, the Fed is struggling with the decision of whether to allow that, and there's ongoing litigation and legislation brewing over that issue. Again, I would pose the proposition that the banks could, even legacy commercial banks, could issue their own stablecoins and offer the same kinds of technologies that new fintech firms could offer, but competition is not promoting that. So what do I think could promote competition? Well, I think one could start with the emerging technology called fast payment system. What does that mean? It means 24/7, 365, instant payments, real-time gross settlement. Bob gets his money right away. And of course, the CBDC is an example of an RTGS fast payment system. And that's why it's the foundation, perhaps, for improvement. Now, I've given a list of countries that have introduced fast payments, and I want to focus on the last one, which is Brazil, because I think Brazil has found the recipe for creating competition through fast payment services. And let me explain what I mean by that. In other countries, I'm going to pick on the United States for the moment. Fast payments have been introduced by the largest banks, but of course they haven't used it to create competition among themselves. So the Fed has stepped in, and it is going to provide its own fast payment system called FedNow, with the idea that they will provide it to a wider set of banks and create more competition. However, FedNow is being provided to the banks. Why? So that the banks could then choose how they will provide fast payment services to their customers. In other words, it would be left up to the banks to decide how they want to compete, whether they want to lower the walls around their walled gardens or not. And if I were the head of a large bank, I might think twice about offering fast payment services ahead of my credit card division. Here's the structure of a PIX payment, which is the Brazilian system. It's much different than FedNow. In Brazil, every payment service provider or bank with at least 200,000 customers is required by law to provide a common app access to PIX so that Alice can pay Bob no matter what bank or payment service provider he uses, using a simple alias, no muss, no fuss, and no walled gardens, because it's not like Chase would provide fast payments on its app and Wells Fargo would provide a different kind of fast payment service on its app. It's uniform in the economy, and that will strike up a lot of competition. And it's no surprise, as shown on this slide, that transactions per capita in PIX have taken off like a rocket in comparison with fast payment services in other economies. In only 2 years, almost every adult in Brazil now has fast payment services through PIX and uses them. 5 million of different households have gotten bank accounts because of PIX, and 5 million more households that had bank accounts for getting paper money out of ATM machines are now using their bank accounts to make PIX transactions. It's very fast and efficient. Whoops. I'm going to go back one slide. Oh, I guess my laptop doesn't want to go back. I want to turn to another reason that I think competition is short. It's not just in the payment services, it's in the compensation of the payment medium. So this is the last time that the Fed was raising rates. When they got to 240 basis points in April 2019, the blue bar shows that the Fed caused banks to offer much higher interest rates to each other than banks were offering to their customers, which are shown in the red bars. And I see Todd smiling because those red bars look kind of measly small. Consumers are getting a really bad deal on their deposits. And you can look in the recent work of Drexler, Savoff, and Schnabel to see why. It's basically a matter of low competition. What would a PIX like fast payment system do? Or maybe a CBDC? It would make it very simple to move money around and to follow who's offering the highest interest rate. Now, I have some reservations about that. I'm not sure Alice will stop using her credit card and use the fast payment system if the credit card is still rewarding her with a big reward. We have a new PhD dissertation at Stanford by Lulu Wang, who's showing that if you compete with credit cards, they might offer even higher rewards in order to fend off the competition, and welfare would actually go down. So in order to create competition with better payment services, you need to both regulate, in this case, perhaps cap interchange fees, and regulate so as to make an open and interoperable, highly accessible payment service. And if you do that, I would claim that in the next 10 to 20 years, you're going to be doing as much for improvement in the payment system and improvement in competition among banks for payments and deposits as you would if a CBDC were introduced. Let's take the case of China, for example. China has introduced a CBDC and a huge pilot. Many hundreds of millions of consumers have been exposed to it, but very few have taken it up. They like their fintech payment services called WeChat Pay and Alipay. In order to compete, the CBDC has to be more than available. It's got to be accompanied by regulation that encourages competition. And I would say the same for fast payment services. It doesn't work if you simply make it available to the banks. You have to regulate for competition. I'm going to jump. Do I have one more minute, Dirk, or not? Okay, I want to jump to the conflict that central banks are facing. What if we increase competition for banks? Wouldn't that destroy our monetary policy transmission? Because now banks will have to pay more for deposit funding. And it's suggested that that would reduce lending. Well, I am much more sanguine about whether that is a bad thing. I think more competition for deposits would be good, and I don't think it's going to reduce lending very much. Harold and I have had some conversations about this. But all central banks have expressed the view that when they introduce a CBDC, they don't want to harm competition. They don't want to harm banks by creating competition for deposits. And I think they're going to, if they take that point of view, they're going to have a hard time having their cake and eating it too. They need competition, but they don't want competition. That is a difficult position. I'm going to jump right to the end. I've got lots of other things to say, but I just want to give a summary of what I think the official sector should be thinking about right now. And this, by the way, is quite consistent with the most recent report by the Treasury Department to President Biden in response to his executive order on digital assets. First, use regulation and fast payment infrastructure to promote a more competitive, interoperable, innovative payment system. I think that's the lowest hanging fruit. Allow entry by private stablecoins and fintech banks, subject, of course, to compliance and consumer protection and interoperability standards. Continue to develop the CBDC technology. Do the R&D so that you're ready if it turns out that you need a better technology or you need this because banks can't be forced to compete by other means. Support wholesale CBDCs, in this case, for their technology advantages. I haven't talked, although Harold did some about wholesale. there are technology advantages in the wholesale CBDC setting. And then finally, in the international finance area, be very careful with what you create. If you create through a CBDC or a dominant stablecoin, an invasive form of dollar that invades the monetary systems of small emerging market economies, open economies that maybe don't have good payment systems, then you're going to be playing havoc with those economies. So consider that very carefully. It's a two-edged sword. The American government wants the dollar to be dominant, but the United States should also want to be a good citizen internationally and not cause havoc around the world. And I think the euro, the digital euro project, will be in a similar position. Christine Lagarde is moving much faster than the Fed is moving on CBDC, and I think they're going to be facing these policy choices before any other large major economy. Dirk, thank you very much.
Thank you, Daryl. Thanks so much. I'd love to come back to, in particular, the last two bullet points you mentioned. But before that, let's maybe start from the fundamentals. What are the fundamental frictions that we should think about, and what has changed there? We have one question here from the audience. Basically, the question is, what are the fundamental economic differences between the current fiat currency system we have and digital currencies, like cryptos and FTs, etc.? And let me link to that. We know that in finance, one of the critical sources of friction is asymmetric information. And what should we think about that? Do we have more asymmetric information in this new world of DeFi and digital finance, or do we actually have less, or just on different corners of the space? How should we think about that? So to any of you who wants to answer to that. Daryl, please.
I'll start with the Gorton, Holmstrom, Trevidan point that consumers tend to trust in the safety of a safe, quote unquote, safe asset until they don't trust it. And I think could be the case for stablecoins that are not well regulated. The investors in the crypto market were very happy to buy lots of Terra and Tether. And then suddenly they were disabused of the idea that they were safe. You don't want to look into it until it's too late. So I would say there is asymmetric information in the stablecoin market. I'm not as worried about CBDC or bank rail payments. And then, of course, the whole broader area of digital assets raises all kinds of private information concerns that the SEC is pursuing in the United States, with the idea that pretty much everything is a security.
If I may also
Sure.
chime in, I mean, I had two thoughts on that question. So one is, you could also, think about the Middle Ages when people used silver coins to trade, and say, how is that different from the system now? In some ways, that's also about economics, not, but so much more has happened, right? So much more is possible now in the modern world of finance with electronic payments of all kinds compared to the Middle Ages. So I think we are in for another sea change of that sort. The other thing that is important to me is that cryptocurrencies are competition for central banks. Central banks used to be the monopoly suppliers of means of payments of money, with the banks maybe putting another layer on top, but they were heavily regulated by the central banks. So now you suddenly have private entries to that and private competition. So that's that's a new world. Then you have to think about that.
Yeah, I was just going to echo some of Daryl's comments. A lot of work has been put into over many years, making the asset we use as money have as little asymmetric information about it as possible, and that's what we think makes it useful. And so in terms on the theme of digital finance facing classic economic problems, I think that's one of the issues that's coming up. If you really want a stable coin to be effective, you would want to have minimal scope for private information. And how do you do that? What we've done with the traditional financial system, as Daryl emphasized, is created a lot of regulation to help guarantee that the money is safe, and therefore you don't have to worry about other people having information. But maybe that's had the effect of diminishing competition substantially, and that's created some of the problems that new firms are trying to address. So maybe in some sense there's a trade-off there, and we're still sort of looking for good solutions to promote competition without bringing in the possibility of this private information about the value of things.
One of the last bullet points that Daryl showed related to wholesale CBDC that none of you mentioned otherwise. So there's also a question about what are the fundamental frictions these days that something like that might actually be able to solve. And many people seem to hope that it might help in terms of making cross-border payments more efficient. So what is your view on that? Do you think that the fundamental frictions in cross-border payments are technological in nature, or is it again competition, like Daryl emphasized, and regulation, which of course follows, or the other way around, interacts with competition? And it also relates to the third question here that I see. What is the best for international trading? So the cross-border dimension. What are your views on that? You just, yes, Daryl, plus.
Okay, so here I think technology plays a relatively greater role than it does in domestic payments, because in the domestic payment system, banks can, if they wish to, they can make payments efficiently. But in the cross-border arena, there are technology barriers, compliance, and also payment versus payment ways to cover settlement risk, meaning like the famous German bank Herstatt that received the dollars that it was due from New York, but failed to send the Deutschmarks, and the New York bank lost. So in order to protect that, a very technologically very complicated solution called continuous linked settlement was developed, and now covers about 60% of developed market currencies and not really any emerging markets. It's cumbersome technology. It could be supplanted efficiently with wholesale CBDCs using the advantages of smart contracting to overcome the settlement risk and speed of settlement issues. And I think it's being developed right now as we speak by multiple central banks and in the private sector by a firm called Finality. And I expect that to be one of the first breakthroughs in central bank digital currencies. It's not a trivial matter though, because it means that central banks would need to give accounts to foreign financial institutions or have some other sort of workaround. And these issues are being discussed right now in all the major central banks around the world.
Yeah, and this is where it's going to be thorny, and we have already private cryptocurrencies where you can do that, right? I mean, I think that was maybe one of the reasons why El Salvador, whatever one thinks about that plan to use Bitcoin as a means of payment, because if you're in the United States, you can easily send Bitcoin to somebody in El Salvador. I mean, you just have to have 2 Bitcoin accounts and you're done. You don't have to go through the central bank world and the banking system world. And this is, to just liven up the discussion. I mean, that's where I also maybe disagree with Daryl. I mean, I agree with him that the banking system is very oligopolistic and they're charging hefty fees, and you could argue that bankers get too rich and all that, right? But that's true in other industries as well, right? I mean, maybe the car industry is not particularly competitive, or maybe whatever, the wine industry is not. I mean, the wine industry is probably competitive, but you could imagine many other industries where there's not competition, and we don't have the idea then that therefore the government should say produce cars to enhance competition in the car industry. I mean, we would think that that's ludicrous, right? And so the idea that we enhance competition in the banking sector by providing something that the banks in principle could provide privately should make us very nervous. I mean, I agree that it would enhance competition, but it's not an industrial policy that we pursue elsewhere. So I think for many of these things, they're private solutions. You mentioned PIX in Brazil, which is a government solution. There's Venmo in the United States, which is a private solution. There's PayPal, and I always think of the telephony that was developed in France by the public telephone company there, and it worked very well, but it's now hopelessly outdated, right? They didn't innovate, right? So now even the French use iPhones and so forth. They no longer use the government service, I think. So I think we want to be careful about calling for the government to solve private solutions, but rather, make sure that there's more competition in the financial system by enhancing that through proper regulation.
Totally agree, Harold.
So let me
you're
just
supposed to disagree. And
yeah, okay. Well, let me slightly disagree, Harold. I mean, if we interpret a CBDC as the central bank opening up branches or the central bank designing the app you're going to use on your phone, then I think the car analogy is very apt, right? We don't think the central bank has any expertise there. If the government were producing cars, they probably wouldn't be the best cars. But if we think of it as being done in a way where really the central bank's just providing accounts, maybe interest-bearing accounts to financial firms who are going to provide services, that's something the central bank can do pretty well. And if that small step is leading to a big change in competition, then maybe that is a reasonable way to do it.
I agree with that too.
Let me try to link your responses here to a question I had, and that I think also rhymes into some of the questions we have here from the audience. A lot of the discussion that comes to the conclusion that CBDC is a solution in search of a problem seems to have a very consumer-centric view. What the government can do, the private sector certainly can do much better. But then on the other hand, in terms of social benefits, not necessarily private benefits for the users, CBDC seems to offer quite something, right? I mean, it could resolve some of the too big to fail problems, could make regulation much easier. Maybe it would require less deposit insurance, et cetera, et cetera. So there's quite a few benefits that we could reap without actually having a better, mobile phone technology in our hands. But on the other hand, as you all mentioned, there is the potential danger or risk of banks losing funding. Some of you said this is not a big risk anyway, because they should have more competition. Others seem to view this a bit differently. So my question number one is, I mean, how much should we weigh those public benefits of CBDC as opposed to the narrow benefits for users? And number two, what does finance and macro and monetary economics teach us about the social usefulness, the complementarities between bank funding and bank creating money? Is that a big deal, or is this something that we could easily dissolve with?
I think you're already seeing evidence of the unstacking or destacking of bank franchises. You have deposits and payments, and you have lending. Meanwhile, private equity firms are coming in to lend. You have PayPal and other entrants in China. You have WeChat Pay and Alipay that have stripped almost entirely the payment services away from the banks. I think these revolutionary changes are coming one way or the other, whether the government introduces a CBDC or not. In the United States, I honestly think it will take over 15 years before the government could reach all the necessary policy and technology changes necessary to introduce a CBDC, and that the improvements that you described are better achieved in the short run with regulation for competition.
Yeah, Dirk, I'd say this is where the issue of inside versus outside money is kind of relevant. What you were describing as potentially the public benefits, yeah, I would sort of recast that as you can think that the private sector in some ways struggles to produce safe money, and we've had to sort of help the banking system produce safe money with things like regulation, deposit insurance, and so on. And if we think then the public sector can provide safe money directly, right? You could think of that as taking some of the pressure off of the banking system, almost freeing the banking system up to do other things. And as you said, we could loosen regulations, maybe loosen leverage regulation. Maybe that would be associated with a decrease in deposit insurance. So I think that's potentially a big deal, right? And in some sense, it's orthogonal from the payments issues that we're focusing on. So as Daryl said, the private sector can provide a lot of payment sector solutions, and if we enhance competition, maybe we'll get a lot of innovation there independent of a CBDC. But what seems more fundamental to the CBDC is what do we want, the type of money we have people holding. Do we want it to be public money or private money? Do we want it to be backed by a loan portfolio on a bank balance sheet, or backed by the central bank? And I think that has important implications.
And maybe 2 points. So Daryl emphasized at some point that the way central banks seem to think about CBDC is having the cake and eat it too, and you can't do both at the same time. Once a CBDC is introduced, you know, you can either let it fail and becomes like a St. Anthony coin and nobody uses it. I mean, then it wouldn't be disruptive, but then why introduce it? But if you introduce it and it's used on a large scale, it's going to be very, very disruptive. And that may be fine, but you just have to think through the consequences of that. We can't just imagine that the banks will continue doing what they have been doing and have a, you know, huge CBDC world. I'm probably mildly in favor of a CBDC for rational reasons, but one has to think through that. And the second thing, and Dirk, I like that you pointed that out again, this distinction between wholesale CBDC and retail CBDC, very important, right? I mean, we often talk about CBDC as substitute for money, for cash in the pocket, but there's this whole wholesale you know, arena where financial institutions want to interact with each other. They need some stable coins to make transfers, and they need to do this electronically. They want to get into this world of blockchains and smart contracts and so forth. And that's why these stable coins are so successful and so desirable. And now they're hoping for something particularly stable, which the government can issue. But I also think that the private sector can issue that with a proper regulatory framework, right? I mean, if you make sure that some of these things are very, you know, heavily monitored narrow banks, you know, I don't see why the government needs to issue these, and I certainly don't see a reason for the government to issue its own blockchain, right? I mean, that's what some of the financial world calls for, but that's going to be, and the problems for that with that are so numerous. So maybe you should just make sure that Ethereum is alive and well, and just keep on doing everything there.
Harold, one note of caution is that in some countries like the United States, there is no national payments regulator. And I think that's the case in the pan-European setting or across the Eurozone. And this is problematic because, yes, we want competition coming from fintech payment services, from stablecoins, but without a national payments regulator, it's hard to create a natural regulatory environment for that. And so I would argue that the first step in places like the US and Europe is to create a pan-jurisdictional regulator that can set minimum standards for consumer protection and interoperability, among other financial stability, among other standards for payment service providers. I think this is the reason that Brazil has had such great success with PIX. It has brought all the non-bank payment service providers and the banks together under one payments umbrella and told them what they must do in order to create competition.
We have a couple
very much on board with that, right? I mean, but give that as a possibility. Provide a big platform for everybody that wants to participate and make it attractive enough so that people want to do it. And then you have network effects, and and I think that's what we saw in Brazil. I agree.
We have a couple of questions relating to trust. And let me frame the question like this. One of the arguments that we often hear in favor of CBDC is that with the disappearance of cash, that some people say is coming more and more quickly, eventually central banks would sort of lose touch or lose the connection to the non-bank private sector unless they were to issue some digital means of payment. And if they were not to do so, then there's a risk that trust in the monetary system, in the pillars of the fundamental system, could be lost. The uniformity of money could be at risk, etc., etc. Do we have good theories that allow us to think about that? And if so, or if not, what is your gut feeling otherwise? Is this argument sound? What do you make of that?
It's very sound. Prior to the national banking era in the United States, there were competing private currencies that caused great problems for financial stability and investor protection. And so, you really do need trust in money. Now, in most developed market economies today, banks are heavily regulated, and there is deposit insurance, and there's plenty of trust in the system. One therefore either needs to have payment services provided by banks, or one needs to extend, as I mentioned, payment services regulation across the economy to non-banks as well. By the way, there's an excellent new paper coming out of the Bank of Canada. I don't think it's been released yet. It's by Scott Hendry, Garcia, and Ravanendria. I strongly recommend it because it has one of the most cogent discussions of in response to the question you just asked her.
So, I agree with that. I might say things a little bit differently. So I agree. It's like the argument says we need a central bank, and we need the central bank providing at least reserves. So it's connecting the financial system, the banking system. It's less clear to me that it's really important that the public have direct access to central bank money. If we have trust in the banking system and the central bank is ensuring the uniformity of bank deposits, $1 in one bank is the same as $1 in another bank, and to promote competition, maybe we want to broaden that access to the central bank to include not just commercial banks, but other payment service providers. I think if you have that, it's not clear to me that having the public directly holding a form of central bank money is really critical.
And one parallel to literature, maybe that might be interesting to draw, is the literature on separating train tracks from train services, right? It used to be thought that you have to provide both as a government because there's a natural monopoly, but it turns out the natural monopoly is only for the train tracks. And you could have many private companies operating on these train tracks. I mean, that has a host of other problems, but I think the IO folks have thought hard about it. And maybe that's a way of thinking about, having sort of a payment regulatory platform, but then the means of payments could be issued by entities other than central banks.
We have here a question that I think rhymes a little bit with what Daryl just said. To what extent are competing cryptocurrencies akin to a system of free banking?
Absolutely. That's exactly what we're talking about, whether it's Terra or even a stablecoin that's backed by high quality liquid assets. Unless they're central bank deposits, there's always the risk, like with money market funds, which are heavily regulated, of a run. And so we need uniform access to a lender of last resort or deposit insurance or both, and strong regulation. That doesn't mean that necessarily only commercial banks of the conventional sort should be authorized to issue payment media. But I do think we're not there yet in terms, at least in the United States, in terms of an environment in which you can get competition from non-banks into these services. And as we've all, I think, emphasized today, the missing ingredient, or at least in my view, the missing ingredient is competition.
I would modify this slightly. There should be the possibility for having a sector of the stablecoin sector that's strongly regulated and as a lender of last resort for those that want it. But if others want to be, on their own and be out there in the Wild West, I mean, I don't necessarily see why that's terribly bad. So let them compete.
But what if, let's say, Tether, it is or was until recently the largest stablecoin. What if it became the dominant payment method in the United States? I don't think that'll happen. But what if it did? Wouldn't you change your view and say, oh, it needs to be regulated because it's a source of financial instability?
Well, we have to think about the externality there, but I'm not sure. I mean, it's sort of like maybe breaking up AT&T, or maybe if something is becoming a monopoly in itself, you want to regulate it. I mean, maybe that's your argument.
Yeah. So I think there's an argument on that side, sort of the user side. If Tether fails, what transactions that it was supporting no longer happen. And there's also the funding side. If Tether's a big holder of commercial paper and it's subject to runs, that's going to create spillover effects on the funding of whoever's issuing that commercial paper. And that's something you might want to regulate ex ante as well.
I think we have a minute or two left. So let me conclude with this question on the international dimension of CBDC. Some people argue that because monetary systems are information processing systems, information processing is national security these days, that there's a strong argument for pushing national CBDCs in order to defend payments alternatives that could come from abroad, from other nation states or from the private sector. So how strong is this national security, international relations narrative for a domestic CBDC? Does it make sense? Do we observe that as one of the major drivers of developments?
In China, yes.
Does it make sense?
Well, if you're China's government, it makes sense for you. My personal view is that the way that ECNY, their CBDC, has been developed is not in the interests of the people, because it lacks privacy and potentially could be used to determine outcomes in a manner that's not promoting freedom.
Yeah, if the US government issues a CBDC, do we want foreigners to open bank accounts? What's the control there? Do we allow North Korean hackers to, transfer ransom payments on the US CBDC blockchain? It raises all kinds of questions that I think one needs to think through carefully.
Yeah, I think that's right. And I think, if you think about it from a standpoint of, say, a small open economy, and you're worried about the ECNY becoming a widely used means of payment in your country, might that have implications? And might you want to try to head that off by providing your own something that's more attractive? Yeah, I haven't thought that through in detail, but it seems like there are serious issues that one would worry about there.
Great. So I thank the three of you very, very much.